We also reference debt service coverage and net debt as a percentage of the fair market value, which are not measures calculated in accordance with GAAP. FRP uses these non-GAAP financial measures to analyze its operations and to monitor, assess, and identify meaningful trends in our operating and financial performance. These measures are not and should not be viewed as a substitute for GAAP financial measures. To reconcile net operating income to GAAP, net income to GAAP, I will now turn the call over to our President and Chief Operating Officer, David.
Thank you, Matt, and good morning, everyone. Strategy has not changed. Let me begin with where is at the core of our strategy. We continually evaluate risk-adjusted return. That philosophy has created opportunity is industrial. Industrial real opportunity across our markets. Accordingly, we expect most we are not changing who FRP is. We are changing where increment into a larger contributor to NOI and FFO over time. It is a legacy land position where years of entitlement are an important part of FRP's long-term value creation. Recurring NOI, financial strength, and the flexibility to continue currently $130 million of liquidity. That financial strength gives us the flexibility to lease. During the past year, the acquisition of the Altman delivers to the first quarter of next year, our industrial portfolio at the end of 2025 to approximately 2.1 million. Leasing momentum continues to improve. Property tours propose to have another approximately 97,500 square feet in as a year ago, giving us greater confidence that occupancy into signed leases. Mining generated approximately and continues to provide important funding and balance sheet. Greenville, South Carolina, and Estero, Florida, in the first quarter. 1,827 units to 2,300 and higher delinquency. We continue to the district's regulatory environment. Well, complete the developments already underway, and together, our industrial and multifamily development and $34 million of expected stabilized NOI is FRP's share. Our objective is straightforward, compared with our original plan of $37.1 million. $800,000 from delayed industrial lease-up and family portfolio. This is partially offset by the timing, elevated platform costs, and higher interest expense, and should generate meaningful operating leverage as occupancy its coverage of approximately 2.82 times. Our strategy is straightforward: industrial platform, while maximizing the value of the multifamily. Chief Investment Officer.
Thank you, David, and good morning. I'd like to spend a few minutes providing as the current development cycle continues to evolve. An important place to start is where we are in the life cycle of the portfolio. Activity overall has significantly increased as tenants across the spectrum continue to have solid operational results. Market share. We are observing a manifestation of this across our portfolio. We currently have in process more than 110 substantial completion. While concessions remain elevated relative to prior cycles, rental rates have remained quite resilient. The supply environment is also becoming 2023 cycle peak. At the same time, absorption is strengthening. We believe this combination should create an increase, have made bringing new industrial supply to market increasingly difficult. Last, we have made meaningful changes to how we approach leasing and marketing across the portfolio. We have changed almost all relationships are an important competitive advantage and differentiator as we work to convert this activity to executed leases. Barriers to entry. While the near-term objectives of leasing are scale as we transition to a highly focused industrial operating and investment platform. With that, I'll turn the call over to John Baker for his.
We're down modestly versus a year ago, but largely in line with our expectations. Family assets and our Maryland industrial portfolio over the past. We just have yet to see that activity and engagement translate into additional things we can control. We have strengthened our leasing team to bring in assets leased and stabilized. As I have said before, the single most important. It has the most immediate impact and requires very little capital. All of us are of one mind that given our assets and the team behind them,
The floor is now open for questions. If you wish to ask a question at this time, this morning, that you pick your handset up while asking your question for optimal. To ask a question. Please hold a moment while we pull. Our question comes from Bill with Horizon.
Everywhere in DC and the Sun Belt that's owned by FRP is getting hit a little bit harder.
Sure, Bill. Good to hear from you. We are seeing, positive, is for this quarter, where we're really getting hit 10% lower than the previous tenant, and that's the real headwind. The district's policies. And right now, 12 months, 18 months to get these and that's interviewing but we still have a pretty significant delinquency headwind from occupancy to economic occupancy.
Across Marin, Dock 79, Bryant Street, and Verge, or is it more heavily weighted towards leading rent? Is the issue across the whole portfolio in DC, or is it just specific to certain?
It's across the board. It really is.
And it takes so long that people have learned this. I mean, there's a whole scan. That's the big problem. And it's not everybody, obviously. I mean, most people are getting,
the extent to which it impacts us has sort of ebbed and flowed from quarter to quarter. The real issue that's been hitting us.
Supply really hurts us on the trade outs. We're trying to compete, attract, trade outs. We've got to compete against. But the delinquencies are
the issue for the last few years, for sure. I think it's
Well, I appreciate the call. A little bit surprised because Camden is our biggest. I met with them for the past few years. I have never heard of them mention anything about DC, the issue that they're dealing with. I don't know if it's better, but I'm just a little bit surprised by the delta and the degree of delinquency versus what they are.
So Camden's located where?
13% of their NOI is in the DC, Northern Virginia area. Significant. I mean, if it's 60,000, 13% of that, but tenants not paying, I would definitely look into what.
We'd agree that the screening, and we have been working on that with our property manager for the last. Pleased with some of the results of being able to detect fraud in ways they couldn't before. So we'll continue to work on it for sure. We know it's an issue.
The acquisitions that we've made in the Maryland area for industrial. A little while looked like a really good use. We kind of had, can we just help me understand what the degree of delta? I know you guys have a smaller portfolio. Come through, it's magnified, and I don't know. I can't tell what percent occupy.
Sure, I'll start, and same store, which is really that same lost a number of tenants, a lot of and we really see that taking up that we're in lease negotiations with right now, and we hope to. Chelsea, we delivered last year.
Yeah. So really being caught between sort of larger logistics markets. Looking at consolidation and figuring out distribution operations to service a much larger, call it Richmond to New York City, Pennsylvania, and New Jersey. There's been a tremendous amount of vacancy in southern New Jersey, what I would sort of compounded by the fact that a lot of those sites in New Jersey have economic incentives associated with them, i.e. pilots and other job creation incentives, which further the good news is that a lot of that space has really been absorbed. So the amount of supply that remains competitive, able to capture some of that demand just based on pure story over the last 15 to 24 months. Look, I think it's the local tenant pool, and there are ancillary businesses that servicing a larger tenant base. There's not been a lot of sort of organic growth within that. Organic in nature. So those are the reasons, but I would tell you they're really large and especially
somewhere in that range. And I've seen a lot. You mentioned built to suit. Is the strategy going forward to do any more spec or doing a spec on something like Krause or Mechanics Valley?
Or more spec space into the market unless sort of the fundamentals would dictate. Our focus relative to Mechanics Valley and Krause is to continue to market them as to whether or not it makes sense to develop a spec project. But I don't. There is no immediate or near-term plan. Opportunity to execute that we are in a position to do so quickly.
And since I got you here, the kind of leasing outlook or just kind of update.
So in Broward County, I think by all measures, Broward County really high barriers to entry relative to identify highway systems, actually 3 major highway systems. Funding is not yet delivered. We are very close to site at rental rates that may set sort of new. The population growth story in Florida. There has been tremendous migration from inside or within the state of Florida. That may exist separately within sort of the Tampa and in a central location that allows them to service activity. Camp Lake is really a population growth story based on the large expansion of the residential base in sort of Lake County and the surrounding geography. It's very early in the process. So, I hope that answers your.
No, that's helpful. I think I just want to say that given the 10-year I want the management and board to think seriously about the shareholder, either in the form of dividends we could, that kind of opportunity, there's a real opportunity cost. But I think what's more important is that, 5 years from now, are we going to be still here? I think there's a happy medium, both stock-based comp, but I think I've earned the right to speak my mind freely. That goes into any form of capital return. I mean, the whole point of owning. It's been a really long time, and I think that in 5 a lot of cash flow, a lot more cash flow than it does today. But we're not, when are we going to share in some of the cash flow? I know many people on this call, many, many years. So that's it. And thank you for answering my question.
Appreciate you expressing your thoughts.
Yeah. Thank you, Bill.
Do you guys have any comment on that, or what are your thoughts?
Of refinancing Bryant Street. Is the appraisal, and it did show up there, and I think it's indication of where that market, and I think that's my comment. I think that's a good. The Rowan building.
The Rowan, yeah, that building.
And I think that's
And
so that's,
I don't believe that had any retail. Is Bryant Street more attractive just compared to that asset, or no? Very similar.
our assets, and I'll
And with the development pipe, opportunity zone taxes, I think, are in the first quarter next year. Now earmarked for developments and future use.
that I talked about. The equity capital. The vertical construction capital, I would say that I think about $8 million is void. what we're focused on right now is to entitle and get shovel-ready our sites. So when we see the markets improve, we're leasing and for entitlements. And that's what we have a good stable of cash, or liquidity to do. Right. Credit that kind of gives us $130 million of liquidity. And that's more than enough liquidity to do opportunities.
And how are you judging just in a simple term of thinking about it, you got a 36 million NOI market cap, 8% yield for a collection of assets that their overall thought process on buybacks versus future developments.
Projects to put capital into, and we are always going to opt into new projects over a dividend or share buybacks. Feel like right now we've got a lot on our plate, and to play defense and offense. We reached a point of than a dividend or a meaningful share buyback program would be part of what we do. Any share buybacks in the near term will be done just sort of opportunistically. With that.
Okay, that's all I have. Thank you.
Thanks, Stephen.
Hi, good morning. I just had especially over the first 6 months of this year with the prior 6 months. Should we think about those G&A costs of where they
Right. That's a good way to think of it. We've kind of built out our team, and we have Horizon.
Yeah, I think the only thing in there, David, is there was not $1 million, but more than $500,000. Something that won't recur, but the rest of it is pretty much a flat run rate.
Okay, thank you. I also just sent a
Ted Goins with Solel.
Good morning. Thank you for taking my questions. To our first questioner, Bill, good to have you on the call. We've all sort of leaned into your asking a lot of the. When y'all were talking about the DC market and the delinquency issues and the challenges, and it wondering, we have 2 more plats and we have the bulkhead. Is there a talk, or is there a system in that area, or are we just dependent on kind of absorption, and then we have the low-cost land, so we're the next to build? How do y'all sort of
Yeah, I
Thank you
don't
for the
think
question.
office is in there. Go ahead, David. Sorry.
No, which we called at one point phases 1, 2, 3, and 4. Phase 1 is Dock 79, phase 2 is Marin, and at one point, and then looking at that area and what was going on, family area. You know, there's some headwinds right now. An entrance, you know, to the nation's capital. It's on the waterfront. We've owned that land for a while. It has a very, very of the land that we have, and at some point, you know, create, you know, a multifamily, you know, waterfront. Now, we certainly are not breaking ground right now, you know, given what's going on there. But continue to monitor the market, continue to monitor, you know, we've got great intel into that area. You know, the data that we have is real. It's in our goes and make the right decision.
This period was around now, and
Correct.
is it a relatively short period of time?
We are currently in discussions with the tenant that's been there, you know, to stay there until we're ready to develop. Such a nuance or nuisance to, you know, our adjacent properties, which at this point it's just not. So ready to break ground and develop that site.
Can we talk about the lease of Florida? How do you intend to, through the quarterly earnings release, or do you intend to there?
Quarterly.
Okay. And have y'all moved up a time frame on Brooksville at all?
Moved up the time.
Yes.
Yeah, I mean, of, you know, the right developer coming along and wanting to take that property down. So somebody wants to develop that land, you know, they'll approach us, but you know.
And I think I read most regulatory filings reasonably well, but not always. There was an outright purchase of shares.
Correct.
Yes.
Congratulations on that, and thank you.
Hi.
Hey, Mark.
I don't think I've been on the call before. I'm your fourth, and I'm old, and I've come across many developers who love to develop, and they focus on developing. They love it. Talking about developing. Stop developing. Start managing your properties. The first thing I would do is not do anything more in anchor. Landlords have no power. None. You're witnessing that. You're witnessing that in D.C. You can't say to you, start putting your properties on the market in blue states. And as far as, you develop. Your earlier caller talked about buybacks. I mean, what is the matter with you people? You get this beautiful cash flow coming in. I think you can just go piss it all away. I'm really, really disappointed that you are still talking about, spending another nickel in a blue state. I mean, you don't learn. There. Start buying back your shares, act responsibly, and all of you should take a 20% and stop new developments. I'm your fourth largest shareholder. Pissed. Thank you.
Thanks, Morris.
We have again. Sir, your line is.
Mike, we're having a hard time hearing you.
Bill?
Hello?
Me?
Hello?
Yeah. Hello?
Hi.
All right.
Can you hear us?
Yes, I can hear you guys. I just want to but since other callers have brought it up, I just want to not every day that you get everybody could do the math. If you buy back shares, you're projects out there that will give you that kind of guarantee. Public traded company where I get to just liquidity. No, there's nobody who cares. Nobody that at this point buying back your share will send a signal. Cares that this is trading at a deep discount. I was not going to talk about buybacks today. The answer given, I thought, was just really, really, like I really disagree with. If you could make 80-90% buying back shares, just do that. That's it. I wouldn't go so far to say that far, but I would say that right now, if there's one thing you could do to show shareholders that you care, and if the pushback on that is that you earmark all this order of priority would be you set aside the capital for leasing, you set aside the capital for any sorts of debt that you may have to refi, and then you know, like if you got a shovel in the ground, if you're already committed to building something, you're mid-construction, you set aside the capital for that. Any other capital that you have in excess of that should absolutely be earmarked towards buying back shares. You know, this is not a topic that I was going to get into today, but since it was brought up by other shareholders and also the company's, you know, answer to this just kind of got me a little fired up. You know, I think that it just the fact that, like, this is such simple math, it's such an easy lever to pull. And also I just want to say, we own Camden. Camden, you know, sold their California assets and bought back 6-7% of their shares in the past year. You know, they did a 1031. They did a $3 billion buying asset 1031, and they bought back shares, bought back 7% of their shares at nearly a 7% cap rate. A fantastic use of capital. We're seeing every single large blue chip REIT that we own. You know, there is another company, AH Realty Trust, in your neck of the woods that just bought back, I think, 6 or 7% of shares this year alone. Every REIT that we talk to have told us this is not 2021. This is not 2023. Buybacks is absolutely a part of the capital allocation. This runs from, you know, REITs that are $500 million up to, you know, $20 billion that we talk to. And I think it's just absolutely tone deaf to just say that, you know, if there is an opportunity to go do developments, we're going to do developments. No, you're trading at 2150. You know, the trading liquidity has always been an issue. But I think if you actually bought back $10, $20, $30 million worth of shares, I think the market will actually care. Thank you.
Thanks, Bill.
Thanks, Bill.
There are no further questions in the queue. We did hear closing remarks from management prior to our Q&A session. So this does conclude our conference call for today.
Great. All right. That was something. Thank you all for your continued interest in the company. And this concludes the call. Thanks.
Okay. You may now disconnect your lines at this time and have a good day.